Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And it is a beautiful day here to be with you at Money on Tap. Joined once again with Ben Brayshaw and Dan Mickelin. How are you guys doing today?
Good, Seth. Good. A lot going on in the market these days. Interested to jump into this topic.
Yeah, busy times, but excited for the show. And I think we've got some good information for people if they're following along out there to get educated about some of the things that are happening these days and see if it's the right time for you to get invested.
It is an ever-changing landscape, is it not? We've got lots of stuff that we're talking about today inside of the market. And by the way, today's topic is market trends. Do you follow the money? And that's a question that we ask regularly. Well, here's where money is heading. Here's why. And some of the stuff, maybe it's old news. Maybe it's not the direction that you're comfortable going because maybe you see a big old stop sign down the road. But maybe it's a green light and it's time to go. And there's a lot of different topics or a lot of different kinds of investing that are hot inside of the investment world right now. I think what's kind of funny about that is because we brought up the term hot, and some of the ideas that we're going to talk about as far as where money's going these days aren't what we typically would say are super exciting or really hot inside of a market, but they're very relevant for and important for you to be paying attention to.
You never know when the most boring part of the world investment-wise just becomes the most opportunistic one, some stuff is just lying under blankets of information that no one really can see. And I think that's really where, just kind of breaking down opportunities and trying to figure out how you avoid pitfalls and dealing with market trends and all the different pieces that are involved there. And the amount of data, I think about it, every morning I wake up and I'm like, the market going to be up or down today? And it's like you listen to CNBC or, Fox Business or any of these different organizations. And it's like, if the market's up, they've got a reason for it being up. And this, it's like, the debt ceiling's they're definitely going to come up with an agreement on the debt ceiling. Well, all of a sudden they have this awareness that no one else is guaranteed to have, but that's the reason it's up. Everybody thinks that. It's not, you never really know. I mean, that's the truth. You never know what hedge fund, what pension organization, who's making a shift. And it may completely be meaningless across the board. It just might be they're doing it for a risk issue. They might be doing it for something. But there's huge shifts in the market, and it's not because, every person woke up and said, I'm going to just buy a few shares of this stock today. It's just not the way it works.
It's amazing when you listen to these guys consistently, whoever it is, too. There's not necessarily that I'm saying a better or worse, but, their commentary in the morning before the open and the commentary after the close, regardless of whether they saw the day coming or not, they're going to tell you at the end that they did, and here's the reasons why. And it's they're worse than the weathermen. They really don't need to be right ever. They just entertain you along the way. It's really what it comes down to. Not that there's no value in listening to this. Absolutely there are. But this whole notion of, we're going to talk about kind of what's seemingly trendy through the first quarter of the market, but we open the show with, do you follow the money? There's a lot of investors out there who just take the opposite tack no matter what's going on. The only thing that they do consistently is go the opposite direction of the money and just buy whatever's out of favor. There's a lot of statistics out there that could suggest to you that that could work too. That's a way to go.
Yeah.
All right. It is time for Money in the News.
And coming to us first up out of CNN by Chris Isidori here is, surprisingly, Tesla will advertise for the first time. When I saw that headline, it just really caught me off guard, considering the fact that it's established itself as not only this household brand, but when you think of EVs, it's Tesla's number one on the list, right? It's the tip of the tongue. It's the one everybody kind of defaults to in the same way, almost as if we're thinking about search engines. Well, you think Google, right? Well, they're not the only ones out there, but they've just kind of captured the sector and kind of in their own brand, and they've done so without ever advertising, which I thought was incredibly surprising. But as I thought about it, though, I was like, I can't remember ever seeing a commercial. So
it's
true.
funny that you say that, because I felt the same way. I was like, you know what? I guess they haven't advertised. I'm like, how do I know so much about Teslas when I've never seen anything on TV or a magazine? I just haven't seen anything.
Because it hasn't happened. Yeah.
Well, there you go.
Well, you're about to see a whole lot more of it on, I'm going to guess, CNBC. By the way, talking about just watching CNBC, one of the things that drives me nuts about that channel is the amount of commercials. It's like I just can't get over how much advertising there is. And so we're going to see a ton more Tesla on there is what my takeaway was. But I really did, enjoy kind of, again, Elon Musk saying things that just nobody else will, which is like, you know what, I never really thought about advertising. And somebody asked me, and then he's like, oh, well, sure, we'll do that. And everybody responds in the meeting with applause. And I guess that's the direction that everybody wants to go. And then at the end of it, he's like, yeah, advertising's great. Let's do it.
When you think about the two entities that we follow him owning the most, right, Tesla and Twitter, this kind of rounded out the article is the fact that Twitter exists only by nature of advertising, right? I mean, that's literally their entire business. So, he's got these two kind of competing entities. One's done zero advertising, and the other one exists only for ad revenue. And he's never combined the two?
Well, the article makes a great point, though. It says the billionaire CEO, I'm quoting the article, has for years suggested there's no need for the company to advertise because he claims demand for the vehicles outstrips supply. Like, he's like, why create more demand when, and usually companies want that because, it obviously drives the price up, but he's lowering his price. He's going against everything. And then he goes on and basically mock the other car manufacturers because they're advertising their EV vehicles, which they don't even have available for sale yet. He's like, these people are advertising vehicles that they don't even have for sale. I like Elon in one breath, and I'm not sure if I'm 100% supportive of him in the other breath because it's just like he's all over the place. But it's refreshing to hear that. It's like, you hear this advertising, you're like, oh, I want to buy that. Oh, you can't. But I really want it. Well, we don't actually make it. So then why are you advertising it?
It's almost the state of automakers, at least last year it was, where if you wanted to buy something, you're basically put on a waiting list and you have to order, prepay, order the truck or whatever you're looking for. You're 6 months down the road before you actually get your vehicle.
Well, I think what this means, for a lot of people and a lot of investors as we read through this stuff, because I always kind of mention what we see in these things is really important. I think what we've realized is that the expectation of automakers through this has changed. That's one kind of evolution I think Elon has brought to the table, is that we can provide a car and build it when you want it. We'll show you where it is. You can't just walk into the dealership and just own it. We'll deliver it to your house. He's changed the entire expectation of what car shopping is. It's like you can't just walk in and test drive any vehicle you want anymore. It just doesn't exist, like you point out, Seth. And I think that, when you look at the fact that Elon has, and Tesla as its own, has had a better profit margin than the general car manufacturers across the board, it tells you something. And I don't know if that has to do with the fact that it's EV only. Like, I don't know if it's just like less steel or less this, or I have no idea kind of the schematics of it. But he set an expectation of what a car manufacturer profit margins, delivery, serve, all those things. He's changed the entire expectation of what that looks like. And now we have somebody, upheaving the entire world of the automakers. I think that's great. And I think there's some opportunity in Tesla. I don't know when that's going to be because I wouldn't buy it myself right now. But, I don't know where this company is going to go. I mean, there's 5 models or whatever. So
the stock is up almost 60% year to date. I mean, It's been red hot. So, whatever he's got going on, he does change industry and he's finding success in doing it. So, good for him. I mean, he's a heck of an entertainer along the way. He really is a joy to read about.
Free advertising every time he does it.
Yeah, that's his advertising.
Yeah. Next up, Jessica Dickler brings us in personal finance. U.S. households are hitting their own debt ceiling. Here's how you can avoid default. That's CNBC article. So, hey, the federal debt ceiling is now under this stalemate, right? And basically just looking for them to rewrite what the new ceiling is and what that federal debt ceiling looks like. Unfortunate for the rest of us out here, we don't have the ability to go ahead and rewrite our own debt ceiling. As a matter of fact, the more debt that you acquire, the more that those consumer agencies out there are monitoring that and then lowering the amount of debt that you actually have available to you. So it's an interesting trend to see among the U.S. where the debt, personal debt in the U.S. was climbing, and then 2020 hit, and then it's like the bottom fell out. And over the next year, a tremendous amount of debt was wiped off the table. But since then, it has been just, not quite a vertical line, getting us nearly to $1 trillion of personal debt. And it says a lot about where we're at as a country. And it's interesting to hear the rest of what's going on with that around travel and, Disneyland hitting, not Disneyland. I'm thinking of Hawaii. I don't know why I got the two confused, but Hawaii is now hitting record highs as far as their travel goes. And so there's a lot of spending out there happening. And that's the thing that I was coming back to is what are we going to do? What are people going to do? Because the spending just can't continue to, hit new highs because we're just not making more money for ourselves, folks. As a matter of fact, with inflation and everything else, we're running into less.
I think I'm really glad this article's on our plate today because I was digging through this and it's just, thinking back about the volume of savings that was going on during COVID and how that was just astronomical, like record numbers of savings. People weren't spending money. But now people have gone completely the opposite direction. I'd be curious to know what the savings numbers are globally now and, nationally now. So that's interesting to me. But I think this really brings, to awareness the idea that, if you're struggling with this, give us a call. I've talked to people, we've counseled people, we've, patted people on the back who, through tears of being overwhelmed with debt. And it's like a noose around your neck. People really struggle with this, and it's something that you feel like it's never too late to turn things around. And that this article does bring that into play. And I think that's really important for our listeners to know that, we're all about good finances. It doesn't matter if it's just investing. But if you are struggling with that and you choose not to call, that's okay. But start with a budget. Start figuring out simple ways to meet the needs and what a real need is. Define a need. That's the biggest issue in America right now is I need that 80-inch TV. You don't need anything that's not going to feed you, clothe you, and put a roof over your head. And those are the things that really kill us. And I think it's really, really sad to know that we have shifted this quickly in literally less than 36 months. Because it says like the average balance of a credit card is just under $10,000, and it's just $2,000 shy of an average of being at an what was the word?
He's hitting the credit limit.
Credit limit that you couldn't actually pay back.
Yeah, to me that was the most alarming part of the article, that people are, essentially at 85% of their credit limits, on average as a household across the country, which is, that we all know what that means. It simply says there's not much more room to run there, right? So at some point, we're going to have to start, paying off all these obligations we have. But the difficulty there is that people are finding themselves in this position in the middle of a 40-year inflation high, which these credit card rates at 20-25%. They're through the roof. Well,
that's even higher than that, depending on what financial status you're at. But the other thing is it just points out that inflation is way more than 6 or 8%. It's just a joke that our government tries to it's just blowing smoke saying, hey, it was only 6 or 8%. I don't know anything I'm only paying 6 or 8% more for. Name something that's only up 6 or 8%. Name one thing.
Yeah, it seems far more expensive than that.
I can't think of a thing. You go out, you want to buy a computer, an iPad, eggs, milk, soda. You name something that's only up 6 or 8% because that's an average, right? That's a statistical average. I don't know any statistical. I mean, Seth, can you think of anything that's up only 6 or 8%? Did you?
The only thing I can think of possibly is something that I don't have any need of or use, and it's value shampoo.
Yeah. Well, there you go. There you go.
That's a visual for you folks at home. But,
it's disturbing when you start seeing this stuff, because this is what's really going on in our country. Next up, we have an article here from Joe Top. Buffett buys stake in Capital One, sells other banks. Now, this is pretty interesting because, Warren Buffett's always an interesting character. But he's selling things. He's selling Occidental Petroleum now, even though he filed to take up to 50% ownership. He's selling it. He still maintains a stake of about 23% in Chevron, but he's selling Bank of New York Mellon, and he's buying Capital One. What do you guys think?
I mean, I think you're right. Whatever he does is noteworthy, right? He's one of the most renowned and famous investors, of our time and of any time, really. So, every filing he makes with how he trades his Berkshire Hathaway fund is just big news, and people want to follow what he does. But, to see him kind of buying into some energy companies, selling out of others, buying into some banks, selling out of others, there isn't at least clear to me, trend as to what he's seeing or why he's making these particular moves. But we know he's doing it. So, again, it's significant and it's interesting. And overall, he was in a significant way a seller of stock lately, which is, another thing that, we monitor and take interest in reading about. He sold, what was it here? $13.28 billion of stock out of his portfolio and purchased 2.87. So a net sale of $10 billion of assets.
That's a ton of money to create liquid.
Yeah, significant move.
I've been reading report after report of, potential recession by the end of the year, depression potentially end of the decade. Lots of fear kind of pieces, and I look at companies and opportunities, that exist, and one opportunity is creating cash to look for the next opportunity. And, being patient can usually make you more money than just being reactive.
Looking at what it is that he's investing in, and there's the purchase of 41.3 million stake in Diageo PLC, which makes Johnny Walker, Guinness, and alcoholic beverages. Then there's also that coupled with the Capital One. Now, when I think of Capital One, I think of credit cards. I don't typically think of Capital One as a bank, even though I know they are, and that's a big part of what they do. But credit cards are synonymous with Capital One. Given the last article that we're talking about, given that interest rates are doing what they're doing, that's telling me something. That's telling me that there's probably a lot more debt accumulation, or at least the profitability on the debts that is being accumulated on those cards is what he's angling towards. That with the recessionary alcohol being one of those stocks that is a recession stock. That's one of those considered a recession-proof kind of a buys out there. There's alcohol and tobacco, and it's one of those things that during recessions that a lot of investors pick up because, well, people have the tendency to be either laid off or at home or drink more, and also just don't give up their tobacco or cigarettes. And so those are consistent profit centers throughout those recessionary periods. And so I think it's a setup. I think that plus a cash position is a bit of a setup. Yeah, so that's some foreshadowing there. Well, all right, that's going to do it with us. Money on the News. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Also, if you are a podcast listener, or even if you're a radio listener and you go over and check out a show with us on the podcasts, we want to thank you for subscribing. Please send us a message at info@yourmoneyontap.com. And we have something for you just for subscribing, just for being with us. We want to appreciate you at Money on Tap. We're going to take a quick break. We'll be right back with Money Trends. Do you follow the money?
Hey folks, Seth Krussman, Brayshaw Financial Group is our company, and we bring to you Money on Tap. I say we, that's Ben and I. We have a lot of fun doing this show. And one of the things that we love about doing Money on Tap is that our goal for you to have access to the financial planning world. How do we think? What are we doing? What are we talking about? Raising the bar of your financial education. It's so critical. And that's what we're doing here. The other side of this is as well, we're financial planners. If you are looking to work with a financial planner, if you want to have that playbook for you to understand the important things right now and how you're going to get to your goals or how you're going to retire successfully, that's what we're doing as well. If you have $250,000 of investable assets, give us a call. It's free to you, and it is worth your time to pick up that phone and give us a call and discover what complete wealth management looks like. Ben and I are excited about the opportunity to partner with you and give you that financial plan that's going to make the next step so much better understood and get you where you need to go.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about the market trends today. And the question is, do you follow the money? So lots of different areas inside the market, right? Your broad market that people will say, hey, it's the S&P 500 or it's the Russell 1, 2, 3. And they'll, break the market into these different segments and still have lots of different opportunities in different areas. And there's more specialty inside of the market. And the term that we get a lot is thematic investing with some of those specialties. For instance, you might take part of the NASDAQ that focuses on cybersecurity and really just create, say, an ETF around that investment theme. And then there's another one that's out there that might be like value investing, looking into value stocks. And that can mean lots of different things. You can have small cap, mid cap, all these different ways of investing. One of the things that comes across regularly is a concept or an idea of following the money. And the market has trends, it has flow, it has, money has a path. And there's a lot. I mean, we're not talking about what your neighbor's doing next door. We're talking about, large investment companies and market space that are moving billions of dollars in directions because they're looking at, a lot of analytics and numbers, and they're understanding the market in a different way, usually, of how to be opportunistic and where those opportunities lie. And so that can be a market trend, and that's also a money flow. And so that's one of the questions that we're asking is what we're seeing right now, what's hot inside of investing, or where has the money been flowing? Are you participating in that currently, or is this something is specific to you and you need to be paying attention to and in front of or a part of? And, it's always a part of what's coming across our table at Brayshaw Financial Group. We meet on a weekly basis inside of our offices to discuss our portfolios and where we're moving our clients and paying attention to what's going on inside of these conversations and how we want to participate in this. And so we're welcoming you today to kind of be a part of, we're not going to be necessarily talking about specific investments, but we're talking about these broad ideas of money flow, market trends, and what's important. And we want to just welcome you inside of Brayshaw Financial Group and Money on Tap and have a conversation with us today. And if this isn't a conversation that you're having, give us a call, 855-226-8551. And that's all it takes to start the conversation with us at Brayshaw Financial Group and Money on Tap. And it's a lot of fun. We just yesterday meeting with some new clients, I had to kind of stop myself and realize I'm starting to get really excited about this conversation we're having, because what I'm seeing, I understand that right now you're a little nervous. This is not a conversation that necessarily you're just prepared to just get shot out of a cannon and have immediately. We've got to kind of dip our toe in the water a little bit here. But what we can see as planners a lot of the time is the direction that we're going, the changes that we're making, the outcomes you're going to start to experience, the freedom you're going to start to have. And that is amazing to have the opportunity to be in this space with you today. So that's where we're going, folks. I look forward to going a little deeper here with you now.
Yeah, I think it's well said, Seth, about trends and how specific some of them can be, and how it's part of our role to kind of watch that and evaluate those things, not only from our personal perspective, but significantly more so on behalf of our clients, right? Because these hedge funds are moving into one of these things. That doesn't mean someone's 401k should, right? I mean, it's a very, very different decision at that kind of level. And we're trusted to guide people accordingly. And, so we evaluate these things. We take a look at it. But this doesn't mean and shouldn't be taken by anybody listening here today that we're saying, hey, you know what, this is right for you. What we do want to do, though, is offer a little education around, if you're hearing these things like we're hearing these things or seeing them in the news, we want to help you understand what that means and why that may or may not make sense for you.
Yeah. So, I mean, guys, how many phone calls do we get of like, hey, what do you think of this stock? Or what do you think of that company? Or I read this article daily.
Or I watched this Netflix show.
Yeah. And I'm thinking about buying this. Or, hey, what do you think about buying Netflix? It's like there's just so much stuff about the world around us that drives where people invest. And I think, when we kind of get into the first one, the most common piece that, we hear about is is artificial intelligence. That's like kind of number one. I hear a lot of AI. Hey, Ben, how do I invest in AI? I got a call the other day. We went through all the tradable AIs. And we talked about this on Money in the News last week, which is kind of interesting that it's in this week's show, too, in our prep, kind of crisscrossing it. But I think it's important because there's so much financial infrastructure going into kind of the pre-end of AI still. Like there's so much development. I mean, there's so much money being thrown at AI, like literally one of the articles we read said that all you have to do is come up with a business plan that uses the word AI and someone will give you money.
Yeah. I have this conversation with people, both work related and just anecdotally sitting around talking with people. And, everyone knows AI. They know what it means, artificial intelligence. But that is pretty much as deep as the pool gets, right about there.
Yeah.
So just understanding, truly what it is as a tool, which is, it essentially, might as well offer it for everybody, right? It's computers who are trained to think like human beings, but just to do it quicker and more accurately, hopefully. And it's got a lot of application in places like, self-driving cars and in the medical world about diagnosing disease and building medicines and, investment world, these robo-advisors, right? They're following trends in the market and making predictions on the future. So it's easy to see, where the industrial application could be, right? The scary side is kind of twofold. Are they going to, go Terminator on us and end the world, or are they just going to eliminate all the jobs?
Yeah.
Right. And those are the two concerns out there relative to this AI technology. But, again, its practical application is just too inviting for industry and investors to ignore.
Agreed, and I think the concept of AI is phenomenal, and there's we could get into the ethical dilemma around AI pretty easily, right? I mean, there's so much to this. I mean, they're talking about the amount of regulations they'd have to put into place. I mean, I was listening to an article, something on TV. I don't know which program it was, but you were just talking about how much work our government's going to have to do just to regulate AI when it gets to a point where it's just too much. But honestly, I just question, because now that it's public, you're telling me that there's not a private AI out there that's just totally crazy and outperforming all of the stuff that we have publicly. That's free.
I mean, that's always the case, right? I mean, we can't restrain anything. We try to, we write the laws, but it doesn't matter.
Yeah.
I mean, so.
And so that the AI concept really is very interesting, because I'm curious how so much of this predictability and the work around this is going to drive what people invest in. Hey, what stocks should I buy, Mr. Mr. Chapchat or whatever, like these are major issues. And I think when we start thinking about trends and how trends change, people say, well, AI sounds great. And, we could sound naive and just say something along the lines of that, it may amount to an absolute hill of beans, but we all kind of know it's not. It's kind of like when Apple created the phone and the cell phone first came out. And I remember I'd listen to older adults be like, no one needs a cell phone.
You're not that important.
You're not that important. Like, come on, no one's going to need a cell phone every second. Like, you can wait 3 minutes to call somebody or wait till you get home. And
don't you have a pocket full of dimes?
I haven't heard that in a long time.
You're not that. So I mean, it's one of these things that I think this is a major player, and how it's utilized. This is Terminator stuff. This is, movie Terminator. Like this is wrapping it all up into where we're going. And to think that this is not going to be a crucial piece of almost every technology that we see moving forward is interesting. But what's really, and we talked about this last week, that AI is not a solely functioning software on its own. It sits on top of another software. It works inside another software. So it is not its own platform. And that means that these things are going to be used in every sort of fashion out there for all of the different pieces, all the different types of technology.
And one of the tricks to it is, around this question of investing in it is, some of the leading things that we think of when we think of AI in the news lately, ChatGPT being by far and away number one, well, that's a privately held company, right? You can't invest in that. So finding where the opportunities actually exist to invest in the technology, isn't quite that easy. You want to invest in an oil company, you can buy Exxon, right? You just think of the brand that's out there and you can buy that very quickly and very easily. But AI takes a little bit of digging. And what I think is out there, and it's probably a way to approach this from the investment perspective, is trying to discover, the companies out there that build the components of it, right? So it's not an end user product that is well flushed out or profitable, or really they've even found a way to drive revenue through it at this point. It's still too raw. But, AI is built of certain technologies, and there are manufacturers of those, and there are ways to get invested there. There are a couple ETFs, which we like, and we talk about those often, that kind of focus in on the AI marketplace. But they own companies that we do know, things like Amazon and NVIDIA and Intel and Advanced Micro Devices. These are companies that are already out there in the tech world that are making significant bets themselves on being a player in the AI space. And that's really probably the best way to get invested in it right now.
Well, like I said, it's sitting on top of Microsoft. That's how they're going to use it, and they're investing in companies that aren't available for us to invest. So the only way to get that exposure, which is why I think Microsoft's seeing the gain and the rise that it's seen in its shares. So I think the next thing. Oh, go ahead.
You guys have already taken all the good stuff, so I guess I'll go a little dark with you on this next level here. Investing in the parts and the pieces underneath that layer of the AI is really what people keep driving at under and towards having an investable option here, putting those ideas really in some other people's hands that are researching and developing those ETFs to be able to be investable. Is the thing. Unless you happen to be really deep inside of the technology yourself and understand, okay, this is what's coming to the table and why I'm going to invest in it. That's predominantly the way to become an investor. Having an experience recently with some of the AI technology, there was some things to kind of be aware of, like what are like the opportunities are limitless. Like the outcomes are kind of the limitless piece. Where, for instance, how many people like to go to WebMD and self-diagnose, right? Well, AI could be that interface for you to go ahead and say, hey, here's what I'm experiencing, and then have that conversation with the AI, and then that AI turn around and maybe take a look at some of your tests and say, well, it looks like you've got something, this is what's going on, and this is what I would recommend. So I am curious about that part in the medical field. Is that going to become that efficiency for the medical professionals, or is it going to start to take over and people are no longer going to start to trust their doctors because the AI over here has given them some other diagnosis, and now that's what they feel like they should have. Now, to go a layer below that, here's where people need to be cautious with this, okay? Right now, SNAP, right? Snapchat has an AI interface where predominantly kids are interfacing with this. And in a matter of a couple of questions, it is going completely woke with the questions and with the answers and with the solutions for our children. Okay? So I want people to be aware that that's who's underwriting the solutions here in this AI. It can be given direction. All right. And that means that if it is in a medical experience, that it can be given direction to diagnose or prescribe for you medications, which of course we know Big Pharma would love that. Okay. Now I think that there's a lot of great things about what solutions can come to the table as well. And I think that's the other side of the AI discussion is like how quickly can some real solutions in medicine start to come to the table that maybe takes years off of the table of development. So, that doesn't necessarily have anything to do with the investment or the underlying investments. But since you guys took everything else, that's what I got.
I did read one other funny one just to wrap this up, but I think it's one of the founders of AI, or the early scientists involved in it, said that AI is going to quickly find humans too boring and not going to want to talk to us anymore. So,
all right, next up, rising interest rates. Something that's really an interesting trend, and I think what's really interesting about the interest rate space is that we have seen the fastest growth of interest rates since the highest level, actually, since 2007, the highest growth period in any time ever. So that has really changed the marketplace. And I think for a lot of our listeners, you may or may not be aware, but the interest rate space obviously has been low. We've been able to get mortgages really low, but that's also redefined the bond market in a way that has been, really unattractive. It's not been something that people have really wanted to put their money into because, putting $1,000 or $10,000 or $100,000 into a bond that's only going to pay you 1% a year, for 5 or 10 or 20, it's just not really great, exciting opportunities, especially when you want a high quality, high rated bond. And so you'd have to go to some really significant risk really to get some sort of palatable return that might be something you might want to retire off of, which a lot of our retirees look at. Well, with the bond market space and so forth being interesting, the interest rates are all over the place. And the Fed is still talking about raising rates. But inside the pricing power, I think we are seeing that the expectation is that rates are going to come down over time. And so as we're kind of digging through, where do, rising interest rates play their part, there's a lot of opportunity inside looking at various spaces that can find profitability in that. Healthcare being one of them. Technology, can benefit, but it can also be a major hindrance. Usually when we see rates go up, technology falls aside because they can't borrow money to build growth. But that has not been the ongoing trend.
Yeah, there's two things that are interesting about what's happened in this rate environment that are kind of different than what's traditionally been the case is, usually this would be good for banks because they can charge more on the money that they loan out. But because banks have had so much of their investable assets wrapped up in essentially underperforming, undervalued bonds, it's caused this massive rip in the whole banking system, even though those losses are only on paper, they're unrealized, but it's really shaken the system. And then back to the point about technology companies.
Which is no fault to the bank. I think that's important to say. The bank didn't make a mistake. They bought the investments that were offered by the Fed at a 1.7% a year ago. And now they were
doing what was prudent and sound in their investments. They were not like... Yeah.
The Fed is totally responsible for these crashes. I mean, if anyone's going to say anything different... Yeah.
Yes.
I mean, there's SVB, inappropriately gave to lots of different woke institutions and so forth. So taking that off the table, the investment structures, the things they were buying were exactly within the realm of what they should have been buying. Whether or not that they made donations to organizations that I would completely disagree with, that's wrong with people's money, but that's not the real issue. The real issue is the devaluation on paper of older bonds being worth less now that new bonds are paying a higher rate.
Right, and it's this appearance of loss more so than actual loss that's created this emotional reaction that this whole run on the bank concept. So that's but it's happened. I mean, we can't ignore the fact that several very large banks have all failed. But the other thing that's been interesting and kind of atypical is that to your point, Ben, technology companies usually suffer in a high rate environment. But there's a segment of the tech world that's flourishing right now, and it's those technology companies that don't need to go borrow. It's the ones sitting on a ton of cash, the Apples of the world and the Microsofts and the more mature, developed technology companies that are kind of past that speculative growth phase. They're doing very well in this time.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about market trends, and do you follow the money? Guess what? We have something for you here at Money on Tap. If you're new to podcasting, if you're subscribing to Money on Tap, send us a message at info@yourmoneyontap.com. We've got a special gift and a thank you for you. We want to appreciate you for connecting with us here. And we'll look forward to more investing. We'll be right back.
If you're listening today and, your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And we are talking about market trends. Do you follow the money? If you're new to Money on Tap, or if you've been here with us for a while, we'd like to introduce you to the podcast and thank you for subscribing to the podcast. When you do that, send us over a little note to info@yourmoneyontap.com. We've got something for you. We want to send it out as a thank you and welcome aboard with us. And appreciate you for just being here with us at Money on Tap. We are in it today because there's just so much to talk about inside the markets. And sometimes we take a little bit of a break, a little bit of a breather, and talk about some other things, because that's the way it is in three-dimensional investing and three-dimensional planning. Not everything is the market. We spend a lot of time in that, and it's a focus for us, and we enjoy it. And but there's a lot more to you as a person and how to protect you, how to protect your wealth, how to create wealth. Lots of concepts that we got the opportunity to bring to the table here with you. And one of them is a story. I want to say it's a story as long as time itself. Not really. It's a story that's fairly recent to us. Within the last 20 years, and it works perfectly inside of this idea of income investing. And Ben has been on a soapbox for several years, and he got on that soapbox, I want to say, years before this was even a conversation inside of investing. But it had to do with a demographic that is moving through the U.S., and that is the baby boomer demographic. And that being one of the largest, it used to be the largest accumulation of wealth in our country that we've ever seen. And that demographic having some really specific needs. And investing, us being, taking a look at the supply and demand and investing based off the needs of that demographic. And you know what? That's enough of the thunder for me. I appreciate Ben letting me steal a little bit of it, but I'm going to hand it back to him to talk a little bit more of what is this income investing idea, or working inside of this demographic and investing alongside.
Well, yeah, Seth, I have been on a soapbox. It's been well over a decade. I think, 2000, Dan knows 2010, I was doing seminars and presentations all over the place talking about demographics and the changing and what was coming down the road, and we're seeing it. It's playing itself out. And it's going to continue to play itself out over the next 20 years because a lot of people don't realize that the investable assets, the largest investable asset group is the baby boomers. I mean, we're not talking about just total assets. We're talking about cash in the market. That group of people is focused on retirement. They have built this wealth, this huge pile of money. And they're also going to create the largest wealth transfer in history that's coming up over the next 20 years as well. So there's a lot of money movement here. And without taking too much time to discuss this, as the baby boomers are retiring, there is this desire to reduce their risk and to, create that income demand that they have to facilitate retirement and replace their paycheck. I mean, it's really that simple. And those types of needs, completely move their current investment strategies that they've been employing for the last 40 years to an entirely different investment strategy. Something that has lower risk that automatically produces income. And we find that to be, highly sought after in the high yield blue chip stock space, the larger stock area. It also is now kind of rejuvenating itself, but the bond market is becoming, more palatable because of its returns. All of these things are, the natural interests of the baby boomer generation as they move out of that accumulation phase, that growth of wealth, that development of their wealth, the building of their wealth to this distribution of their wealth, the distribution phase as we call it. And I don't think people understand that impacts the market in ways that are both positive in some spaces and negative in others. Because if you're looking to de-risk, you're going to sell your higher risk assets that maybe you've had some position in over the last 40 years of the baby boomer. And if everybody's doing that, those assets are going to drop, even if they're perfectly fine and good. It's just more risk than people want to have on their plate. But all of a sudden, as people become more interested in high yield assets or dividend or bond stock kind of spaces, those assets become of higher demand. Those stocks rise. Those bonds become more in demand. So there's just a complication here that's going to happen just because of the natural trend of that demographic. The income investing phase, the whole desire of accomplishing that, I don't think people realize that we have 20 more years of baby boomers retiring. I mean, it is a massive group of people. So it's really complicated to process that because right now we have 45 million Americans retired, and we're going to have 120 million Americans retired in the next 20 years. That's a tripling of that number almost. So there is a lot of this money movement that's happening. And the way people made money is not how they're going to be making money over the next 20 years in the same equal capacity.
Yeah, these people in this group are going to, not to overgeneralize, but they're going to move away from growth and be invested in things that pay them to own it, where the share price being stable is okay. They don't need the share price to necessarily appreciate. They just need that asset to spin off income for them. And that has been largely confined to the dividend-producing stock world. But in the last couple of years, or certainly since we've experienced this inflation spike, bonds came back into favor that you mentioned there, Ben. And then, something that's been kind of dormant for years is, simple banking instruments like CDs and money markets and things like that are paying off, between 4% and 5% as an interest rate now. So those have become usable tools again for the first time in a long time.
Well, I would even go a step further and say the annuity conversation is, something the fixed annuity space usually beats the CD rate space, and it's tax deferred for the non-qualified or the non-retirement funds. And those are interesting because we're doing those things at over 5%, which is great. But even the index annuity space, and people say, well, annuities, I don't understand them and so forth. It doesn't really even matter in this conversation about understanding them. But what's interesting about those is that they're mostly backed by what, Dan? Bonds. So, it's like you're still making a bond play on some level, or even real estate, right? I see a lot of real estate investment trusts in the backing of those too. So you're still playing in the same very conservative space with another conservative instrument. And I think a lot of people don't understand because those, obviously annuities are complex and they got a lot of detail around them. But it's important to understand that there's this massive demand for this, and these interest rate hikes, they're great. But if everything costs you 25% more and you went from making 1% at the bank to making 5% at the bank, it still doesn't cover the cost.
No, when you think about, if you look at bond yields in general, right, the 2 years higher than the 10, right? Yeah. And it has been on and off. I don't know where it stands exactly today, but that's been a common theme over the last 6 or 8 months. But you can get in that 5-year annuity at from 4.75 to 5.25%, and it's locked in for those full 5 years. So that's longer than the duration of that 2-year bond. So you can kind of play a middle of the road bet there to kind of extend that higher rate opportunity past what the U.S. Treasury is offering you there.
Yeah. I would say the demographic space and yield investing, income investing is a trend that has a macro event occurring. There's something going on there at a level that's really kind of quantifiable. The next item we have is ESG investing. I get the phone call on the ESG and I just want to throw up. Go ahead, Dan.
Yeah, we've been down that road. The environmental socialist governance style of investing is, kind of fits right into the woke world we're in these days. But there's a couple things going on in that space. And the biggest one that's kind of opened up floodgates of inflows is that, the Biden administration has enacted some laws that allow these things to be present in 401k platforms, right? So the retail investor with their retirement assets has just gotten a whole lot more easy access to making this an investment choice on their behalf. The difficulty in it is, and there's some challenge around this, is we're all bound by something called our fiduciary duty, right? Where we're beholden to do the best that we possibly can for our clients and their money. And these ESG funds have somehow kind of skated that in a sense, or possibly have, because their goal with your money, and this is the lesson for everybody to really tune into, the goal for their investments behind the scenes does not have to be returns for you. And that's kind of an incredible notion in the investment world, that they're allowed, these ESG funds, right, their fund managers are allowed to take your retirement dollars and invest them in social/political causes that don't necessarily have return on your money at the forefront of their mind. And generally, when we're advising people around retirement dollars, in the accumulation phase particularly, it's about where can we do the best with this money? Where can we multiply it quickest and easiest and safest? I mean, those are our considerations, right, at lowest cost. We're kind of bound by considering those things, whereas ESG funds now have the opportunity to introduce things into their realm of consideration that have nothing to do with the benefit of your retirement account.
And maybe a lot to do with absolutely everything that you're against. I think that's the biggest issue. You don't even know what social programs are involving themselves with, and it's usually not in the space that I agree with. But some of the companies that kind of come to the top of the ESG ETF space, American Express, Accenture, Disney, Home Depot, Hasbro. I mean, these are lots of companies that have just so woke, they're so far past the guardrail of any road. It's disappointing. I mean, we were talking about it during break, how Disney has actually had even further losses in their subscription basis. And what did you say, Seth? You said, I'm getting rid of mine.
Yeah. I'm trying to figure out how do I do that when I'm all wrapped into the bundle thing that they've had going on. It's a baffling thing to be able to just invest more on a purpose, I guess, the wrapper of the purpose versus those investments actually having a goal of growth.
Sounds more like a donation than an investment, doesn't it?
It's like, hey, we're going to charitably give to every organization you're not giving to, and you would never give to begin with, and it's going to be purposely not relevant to being a good steward with making the money we're supposed to make. I mean, it's just totally opposite of any fiduciary standard out there, and the Biden administration is like pushing this thing down people's throats. It just kills me.
Yeah, I think you can be in a different realm when your idea is I'm planting seeds, but the idea of and wait a period of time where you're willing to let that growth happen. But I think ultimately you just go against a biblical principle of growth that doesn't work. It just goes against really the way that we're designed to be. But even when we're giving into an opportunity to see expansion in the world in an area that needs help. It's a very different purpose. And so that's the part where I'm wondering how sustainable is really an ESG platform. So we've got other ways to invest inside of this idea of being principled with our money. Maybe it's biblical principled or other kinds of principles as well. It doesn't necessarily have to fall into the ESG environment. You guys, this has been a wonderful show. I appreciate the time with each of you. And if you're new to Money on Tap, again, thank you for being here with us and joining us in a discussion around your market trends and if you follow the money. And if you are on the podcast venues and you subscribe, let us know. Let us know at info@yourmoneyontap.com or call us at 855-226-8551. We've got a gift for you. Be successful in your investing. Grow in your investing. I like that last part that we were talking about there. And we cannot wait to have you back here on Money on Tap.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.